In this scenario, Entity A purchases 10,000 shares in Entity B for $5 per share. $2,500 in transaction fees were incurred. For Entity A, this is a short-term investment as they expect to make a profit from selling these shares in the near term. As such, the shares are considered to be held for trading and will be accounted for as fair value through profit or loss. At the end of the first financial year, the shares are valued at $5.50. During the following year, the shares reached $6 per share. At this point, Entity A sold the shares, incurring $2,500 in transactions fees to do so. Let's get into it. We start from the beginning on January 1st, 20XO. This is the day we acquired the shares and thus became party to the contractual provisions of the instrument, as per the words of the standard. Therefore, we need to recognize the shares invested in on this day. We note from the scenario that the investment is intended to be short-term, as Entity A expects to make a profit from selling the shares in the near term. As such, these shares are to be measured at fair value through profit or loss. Given this determination, the transaction fees are expensed and do not form part of the value of the asset. To recognize this investment, we need to figure out the value. This is simply the number of shares multiplied by the price paid per share. We know from the scenario that 10,000 shares were purchased. They were $5 per share. Therefore, our investment is $50,000. We can now recognize this investment on the day with a journal entry. The shares Entity A has invested into are a financial asset. So we can recognize an asset by debiting our balance sheet for the value of the shares, which we determined to be $50,000. We can also debit the profit and loss for $2,500 for our transaction costs, which we determined to not be included in the value of the investment, given it has been designated as fair value through profit and loss. Our investment and transaction fees would have been paid by cash or on credit, and so we can credit one of these depending on the circumstances. We have now recognized everything we need to as of 1 January 20XO and can move on to the next period. In this period, we know that the share price has appreciated to $5.50. This is a reporting period as noted in the scenario, and so we need to true up the book value of our shares on the balance sheet to their fair value based on the market price. To do this, we first need to figure out the fair value now and compare it to our book value at present. We know we have 10,000 shares. These are now $5.50 each, meaning our investment is now valued at $55,000. We initially recognized the investment for $50,000, given the shares were $5 at the time of purchase. We therefore need to recognize the difference of $5,000. The way we do this is through debiting our investment for the gain, as we need to increase the asset. The other side is credited to the profit or loss, being gain on fair value through profit or loss assets. This is a credit to the profit or loss as it is an increase in an asset, which is essentially another form of income. We have now recognized everything we need to as of 31st December 2010 and can move on to the next period. Again, the shares have appreciated, this time to $6 per share, so we need to recognize this gain as well. We can perform the same exercise. Determine the fair value at present and compare it to the book value. We still have 10,000 shares. We have not bought or sold any. The share price is $6 as noted, giving our investment a fair value of $60,000 based on market prices. Our book value following the December revaluation is $55,000, which means we have another $5,000 gain. We can journal this in the same way as the other adjustment by debiting the asset and crediting income. We can then recognize the sale of the asset. We know from just revaluing our asset it is now $60,000, so we can credit our investment for that much to derecognize it. We know that this is the fair value on the market and the amount that will be realized in cash, so we can debit cash or receivables as the other side of this journal. Then we can deal with the transactions costs by simply debiting expenses and crediting cash or payables. You may notice there is no gain or loss attributed to the sale of these shares as part of this journal. This is because the gain or loss has been recognized over time through the revaluation of the investment through the profit or loss. And with that, we've finished our IFRS 9 investment in equity instruments at fair value through profit or loss. Worked example. Thank you for watching. If you found this helpful, please like and subscribe. If you'd like to see worked examples for other accounting topics, leave a comment down below. See you next time.